Another U.S. bank just failed. Last night, after markets closed, we got the classic Friday news dump when they hope nobody's looking that Heartland Tri-State Bank in Kansas has failed. This is the fifth U.S. bank to fail this year, joining Silvergate, Silicon Valley, Signature Bank, and First Republic Bank. And let's also not forget the non-U.S. credit Suisse that failed, and PacWest Bank that was just rescued from failure this week. Now we've got Heartland Tri-State Bank joining the ranks. So is the banking crisis from March still going strong? Does this mean banks are going to keep falling like dominoes? Well, let's take a look at this story and see for ourselves. And here we go, folks. Dated just last night in B&O News, Kansas Bank closed by regulators, fifth U.S. bank failure this year. Heartland Tri-State Bank in Kansas has been closed by regulators after it became insolvent, officials announced on Friday night, marking the fifth U.S. bank failure so far this year. And it was no accident that this story broke on Friday night. Everybody from government to business just loves to put out bad news after markets close on Friday when they think nobody's paying attention. That way people have the weekend to digest it slowly and there's no shock from the news. Kansas Bank Commissioner David Herndon determined that the bank, which was based in Elkhart, had become insolvent and appointed the Federal Deposit Insurance Corporation, or FDIC, as the receiver. The FDIC then sold it to Dream First Bank. Heartland Tri-State Bank became insolvent due to an isolated event. Put a pin in that. Overall, the Kansas banking industry is unaffected by this event, and Kansas banks remain strong. And of course, that's the obligatory statement of reassurance that the regulators have to throw in every time a bank fails. They have to tell us again just how strong and resilient our banking system is. One wonders after 5 bank failures, just how strong and resilient is it really? Now, here's where this story gets really interesting for me. In total, the bank had approximately $139 million in total assets and $130 million in total deposits or liabilities. So as of their latest filing, this bank was $9 million in the black. They look solvent. They should have been okay. But now the FDIC estimates that the cost to the Deposit Insurance Fund, that's the FDIC's reserves to make up for bank failures, that cost will be $54.2 million. So something in these numbers really doesn't make any sense here. This bank was supposedly $9 million in the bank. They had $139 million in assets and only $130 million in liabilities. So that $9 million in bank capital, that's gone wiped out. But the FDIC, after selling the assets, is still coming up short by $54.2 million. That means this bank that only owed $130 million is still $63 million short after being bailed out by the FDIC. And they're telling us this was due to an isolated event. So one isolated event cost this bank more than half of their money. Something here doesn't add up. So let's go to the bank's financials and see if we can figure out where did they lose $63 million. This bank that only borrowed $130 million somehow managed to lose $63 million. Where did it go? So this is their balance sheet, and here we're looking under assets. They had a little bit of cash, $1.2 million, $7.8 million. Now, in their securities, they held about $55.6 million worth of securities. Now, all of those securities were cataloged as available for sale securities. If you see here, they're held to maturity securities. That was at zero. Now, one of the tricks that a lot of the banks that have failed recently had been doing is they took all of their things like U.S. Treasury bonds that they had bought, and they were moving them from available for sale over into held to maturity. And doing that allows the banks to hold them on their books as if they're worth the money that they'll be worth the day they mature, not the money that they're worth today if they were to be forced to sell those assets. So that's one of the ways that a lot of these regional banks and the big banks have been hiding their losses on their balance sheets by putting all of those U.S. bonds that are worth less after the interest rate hikes, moving them from available for sale into held to maturity. But that is not what happened with this bank here. They've got all of their securities still under available for sale. So they didn't hide their losses from U.S. Treasuries on their balance sheet. That's not what took this bank down. And furthermore, I'd add that this bank only had $55.6 million worth of securities on their balance sheets. So even if they lost 100% of their available for sale securities, they still wouldn't have lost enough money to explain that $63 million shortfall in their balance sheet. And the losses from U.S. Treasuries are nowhere near 100%. We're talking most of the other banks have had losses of a couple of percent, maybe 10. So it's not losses from securities that failed this bank. what about people not paying back their loans? Maybe that's what caused this big hole in this bank's balance sheet. So let's look at the loans that are on their balance sheets. And here we go. Loans and leases, net of unearned income, $49.2 million. So this bank only has $49 million of loans on its books, even if 100% of all the people who borrowed money from this bank defaulted on their loans and there was no assets at all to seize from those people, you still wouldn't have had a loss big enough to explain $63 million vanishing at this bank. So it's not losses from treasuries and losses from other securities, and it's not losses from loans. But remember, the FDIC is telling us that the bank lost all of this money due to an isolated event. A single isolated event that caused this small bank, $130 million in liabilities, it's not a very big bank, it caused this small bank to lose half of all of its money. And I suspect that that isolated event was something like crime or gross negligence or embezzlement. It's the only explanation I can come up for how so much money at such a little bank went up in smoke so quickly. I suspect this isolated event is there was something going on at this bank that was not above board, and it goes way above and beyond the struggles that have been causing bank failures elsewhere in the economy. This seems like something totally different to me and not cause for widespread alarm in the banking system. So if you had an account at this bank, it's going to open up on Monday morning under the name of Dream First Bank, and your money will still be there. You didn't lose anything. If you owed money to Heartland Bank, chances are now you own it to either Dream First Bank or to the FDIC. And none of the articles I've seen about this bank failure have made any mention of uninsured deposits or deposits at the bank in excess of the FDIC's $250,000 insurance limit. So the controversy over the bailout versus the bail-in doesn't look to be in play here. There's no discussion about whether uninsured depositors are going to be bailed out or if they're going to lose their money like the law says they should. There's no mention of that anywhere in any of these stories. Now, I'd also like to put this bank failure in context. What we're talking about here with Heartland Tri-State Bank, this bank had $130 million in liabilities, all right? Let's compare that to some of the recent bank failures, all right? Right here over my shoulder, this snowman here, these are the banks that failed earlier this year. The second, third, and fourth largest bank failures in U.S. history in Signature Bank, First Republic Bank, and Silicon Valley Bank. The largest bank failure in U.S. history being back there during the global financial crisis when Washington Mutual failed. Now, Heartland Tri-State Bank with their $130 million in deposits, that is a very, very small bank. Seems like a lot of money to you or I, but in the grand scheme of things, Heartland Tri-State Bank is really going to be like one of these itty-bitty little dots above my head here. Doesn't even really register among the scale of some of the other bank failures that we've seen this year. So all by itself, Heartland Tri-State Bank failing doesn't necessarily strike me as a continuation of the crisis from the spring where all these big banks went down, not by itself. If we were to see another half dozen other of these small rural banks start to fail all in consecutive order, then I might get a little bit more worried. And to be clear, I think we are probably going to see several of these smaller banks fail in the weeks ahead. But with a hole in the balance sheet this big, $130 million balance sheet with a $63 million hole in it, I don't think this is losses from interest rates or people defaulting on loans. I suspect it was something a little more along the lines of fraud or negligence. I can't prove that. That's just me making an estimate based on the numbers. So my initial reaction to this story, the only information we have are the numbers and the isolated event. It tells me that this is not something that we necessarily really need to freak out over, but we do need to be vigilant because all of these other banks that are out there do have these big holes on their balance sheets from unrealized losses from U.S. Treasuries, and there is risk of defaults in things like commercial real estate and credit card debt that are going on in the economy. But that's not what failed Heartland Tri-State Bank. I think it was something else. We'll keep an eye on this story, and if there's any more developments, we'll bring them to you. And until next time, live small and dream big.